Acquire, welcome back. Big day. Doug's here. So you know we're serious. You know this is serious video. It's not like an assignment video. This is a big video. General model.
The
Doug.
general model, the general model. So I'm really happy to be here on this video because we're going to actually go into the amazingness of what this notion of entrepreneurship through acquisition is. That might be the fancy phrase. We're going to say, like, what is that, right?
What is acquire?
What is acquire? What is acquire? So I'm going to function a little bit as the interviewer, and Derek's going to kind of walk us through both the kind of the background and the history of this model. And then we're going to walk into what are the pieces and parts that we'll be going through. And these are all the necessary steps that you're going to need to do to actually be able to acquire a company. So why don't we start off, Derek? So tell us a little bit about, this was probably 2-3 years ago. You came across this class, and why don't you, and you were starting to tell me about it. Why don't you just share a little bit of your discovery when you first saw this class and how you came about it?
Yeah, so I was looking at the MBA core at Western Michigan University and the electives, and someone asked me if you could design any class, what would it be? So I started by looking around at all the top schools. What's the best class at the top schools that would be most impactful that I could make a real change from? And I came across the entrepreneurship through acquisition class at Harvard, most popular class, Stanford. There's one at Booth. So all the big schools are doing it. And then it started spreading through the Dukes and the North Carolinas. And I thought, man, what a class. You could actually train students and make them better at any career they were on, but also you could change someone's life, dramatically change someone's life by saying, hey, this is a third career path. You don't have to climb the corporate ladder. You don't have to start your own company. You can actually acquire a company. And then I dug in a little bit and I was like, wow, this is a massive opportunity right now, right? The baby boomer tsunami that people talk about, massive retirements of all these business owners. And we need people, leaders, to step up. And there was the argument that, well, Harvard versus Western Michigan. I thought to myself, no, the companies in West Michigan can be run by West Michigan people. And we have the talent here to do that. So we started with a beta 0.00, and I think we're on maybe V beta 0.2, but we're growing the class, making it bigger. That's where we are today. So
the class and the notion of entrepreneurship through acquisition, which is the fancy term for it, most popular class at Harvard.
Yep.
At HBS, Harvard Business School.
Yeah, it was.
Okay.
It was definitely one of them. I'm not sure if it still is, but at the time it was. I'm sure it still is.
Okay.
Class.
So this is a model that's going on at HBS, Stanford, mm-hmm. University of Chicago, Booth. So some fantastic schools are embarking on this, and these are younger MBAs, full-time MBAs, right? These are 25-year-olds, even 26-year-olds, getting trained on how to buy a company.
Correct.
Okay. So this model has been going on for how long, would you roughly say? And what kind of success are people seeing from this model? Like, how do we know that this model works?
Well, the first entrepreneurship through acquisition done through university was actually 1984. And the returns, I think, were something along the lines of 34x.
34x.
Percent X. Our fund would love to have 34x, Doug.
Okay.
We'd be in good company. 34x, but some of the funds, for example, if you ever have phone insurance for your cell phone,
mm-hmm.
right? That was an entrepreneurship through acquisition company originally, and it was a towing company that a new young entrepreneur got in there, started looking at change, momentum, and decided to put insurance on cell phones and grew that company and ended up taking it public. It's one of the big success. Okay. And the model is proliferated because the market is in demand of it. There's a lot of companies for sale. So we need to train leaders, find leaders of the future that will take over these companies and run them as owner operators.
So you have a lot of companies coming up for sale, a lot of them that don't have a succession plan. So they need an executive that they don't have in waiting that's going to need to assume the leadership. Some of these professors look out, they see the opportunity. They put together this class where you can actually go out and acquire a company. Turns out some of these HBS professors are investing in some
Yes.
of these companies. So they're
Read
bought
the
in.
fine print in the cases.
Read the fine print in the cases. The professors are aligned on their incentives, right? I want to have a great teach someone really well, and if they're going along, that they can actually buy a company. So part of this process is you hear something about search funds. That kind of term we're going to talk a little bit about in this class. How does a search fund, what is that, and how does that fit into the entrepreneurship through acquisition model?
Yeah, so good question. There's going to be a lot of terms, new terms that come up in this class. We'll cover some of them today. Search fund is generally um, a young or an MBA student, not to be young, but a student out of one of these top programs goes and finds investors and says, fund my salary and expenses for 2 years. I will go find a company. And when I find that company, the money you paid my salary and expenses with gets a 1.5 kicker into equity in the company. And you get first right to buy and turn down the acquisition. So they raise search capital, which pays them to go find a company. And then after they find the company, they have to go back and raise acquisition capital, which allows them to acquire the company. Spend a lot of time fundraising that model, a lot of time searching, but it's a model that's been used. There's now funds, private equity funds, that are only invest in search funds, and they hope to get successful with a few of them as they back them. So that's competition, right? There's competition in form of for this path from searchers that have raised search funds, from independent sponsors, from strategics, from individual investors, from family offices to young aspiring owner operators that come through Acquire.
And so the search fund model then is basically someone invests in you, covering your expenses to find a company. You bring them the company. They can say, yes, I want to invest, or they can say no. And if they choose to say yes, then the investment that they're making into that company will get bigger after the bank is paid down. We're going to talk about debt and leverage and deal structure at some point very soon. So it's in the investor's interest, and they're basically finding someone to get them a company. Turns out the search funds are pretty successful, are they not?
Yep.
Very successful. So
yeah,
I was looking.
Everybody involved, for the investors, for the searchers, for everybody involved.
And we should share, maybe at a later date, we'll share that search fund overview, selected observations from Stanford.
Yes,
it is shared.
It's
make sure you make sure you dig into that, folks, because you're going to see some really great numbers on returns and the exit equity dollars that some of these CEOs have after they've assumed leadership of a company. There's a lot of zeros there, Derek.
Yes.
A lot of money there.
In the millions.
In the millions. In the average of 6 million. Okay, so there's a lot of money to be made here. Mm-hmm. It's been proven. Mm-hmm. It's at other schools.
Yep.
Better than starting a company. Is it better than starting a company?
It's much less risky than
starting
a company.
Why is that?
Even 70% of it's like 99% of startups fail, and even 70% of fully venture-backed companies fail. This model reduces the risk dramatically. Now, there's still some that are unsuccessful, but you're down to below 20% in some cases. There's steps to follow. There's tools to use that even decrease your risk within the model. And there's now learning and processes and procedures and tools in place to help you be even more successful within the search fund model. That's what this class is about.
Okay. So we're going to find a company that has has a record of success. Less risky.
Already established customers, right? It's
established proven, customers.
Right? I've startup that hasn't proven a customer need yet. Yep. A company that's been operating for 20 years has already proven the customer need. It's more up to the entrepreneur or the aspiring owner operator to prove that need's going to stay there.
Yep.
And that they can grow into that.
And we'll talk a little bit more later in the class about what makes something more or less attractive, right? Mm-hmm. But let's dive into what let's walk through the stages of the model.
Okay.
So we're talking about 6 steps here. We're going to drill into each one of these steps roughly. you know?
Get roughly, give or take, but about 6 steps, and it's how the modules are organized in the class and what we're going to go through. But yeah.
Okay. And so we start off with a first box here that we're kind of embarking on right now, which is really around self-reflection.
Yep.
And what is
Critical
that?
box.
What are the key, what are the key questions when we think about this bucket that need to be answered before we move on to the next step in the process?
Well, this is where an individual that may be an aspiring owner operator that may want to go down this third career path really has to have a honest conversation with themselves, with those around them, with their family members, understand what their skill sets are, understand what they want to do with their career, understand what their capabilities are, understand what type of company they want to manage. They need to be able to think 5 years, 10 years out and say, wow, if I was a CEO, what would my day be like? Uh, if I was an owner operator, what kind of company would I buy? Uh, what would that be like? Who would I want to come with me, and why would those people need to come with me? What skills would I need around me? For example, if I'm a great sales and marketing person, it might be good that I hire a CFO or that the company I buy has a great CFO in place. Um, and the other part of self-reflection is it gets to the next box, which is sourcing. But the self-reflection box really has to narrow you down because the opportunity is so big and it takes so much time, energy, effort to go through this process. We want to narrow your focus down and dial you in so you can get super targeted in with all the people that you're going to meet along this process and targeted with your journey through the jungle, right? You're going to meet a lot of people in the jungle from all different sources. You need to be able to communicate and tell them effectively so they can help you. And you want to narrow your path and choose a path through the jungle that's going to be successful for you as an individual or operator. And those paths are different for different people. And again, these are only steps. These are only tools. There's other ways to go about this, but in general, this will increase people's success from coming at it from a general standpoint.
So it sounds like we're taking in that first step a sense of what we're able to do,
Mm-hmm.
and that's coming from our own self understanding, but also the feedback from other people about what we're good at, what we're not good at. Are we emotionally made up for this? And we'll talk a little bit more about what kind of characteristics you might need to be really successful in that. So what are some of the, if someone's saying to themselves, this sounds kind of interesting, what are the skills or the personalities that you think really strive and are effective at this model?
Yeah, so that's debatable. If you watch the vision statement video, I partner with this. I go through the three models. I walk through Harvard's what they think is most useful. Independence. You got to value being a CEO. You're going to lose some things. You need some basic management skills. Understand spreadsheets. You got to be able to be a good leader. Perseverance, grit, growth mindset is often mentioned. Um, so there's you got to be willing to make sure that all of your performance depends on you, not someone else.
Hmm.
And people could even say in that aspect, well, I'm better off and safer to stay in my current job. The reality is you can be fired from your current job any day. Happens all the time. COVID downturn, tons of people getting laid off. If you want your future success and others in your hands and be accountable for that, this is a model for you. Um, but you got to be comfortable with that. There's a lot of fear. There's a lot of bigger numbers than most people are used to dealing with. So critical.
So we'll talk a little bit more about that in class, right? About
Yep.
what are some of those skills? What are the things that I need? What are the
Yep.
personality characteristics? But you're going to gather all this feedback.
Mm-hmm.
You're also probably going to take a little bit of stock of what that vision is for the future. So not only what is, but what do you hope to achieve,
Yep.
right?
That's your vision
What,
statement. There's a
right?
video for that. Yep.
Where you're going to be at,
And then in this phase, we want you to create a target statement.
and
Which
that's part
company
of.
do you want to buy? Why? How are you going to change it? What size? And you're going to do all that. And it's going to focus you and narrow you and help you communicate with others.
So I've looked at myself. I've looked at the future. I'm seeing this pathway. I think I can make this work. I have a narrow statement now of what I really want to focus on. What's the next step?
You got to find a company.
Got to find the company. What do we call that?
We call it sourcing.
Sourcing.
Sourcing. And sourcing comes in two broad categories, direct and indirect. And we'll go through all this, but essentially direct is you go direct to the sellers. You communicate with them, you talk with them, you send them emails, you get in hold of them, you find the companies you want to buy, and you track them down at trade shows, Indirect is there's a lot of intermediaries, business brokers, accountants, lawyers, financial advisors. You're dealing with all them, and there's steps in sourcing. There's technology, there's tools, there's email campaigns. I mean, you go down the list. There's finding all the companies that are list. So there's a lot of tactics there, and we'll go through that in the sourcing category. But essentially, companies that are for sale don't have for sale signs out front.
Why is that? Why is that?
Well, because you don't want your customers and suppliers to know you're for sale, right? You don't, and in case you don't sell, you don't want people to think you're going out of business. So it's done in an extremely fragmented market, and in fragmented market, you've got a lot of individuals that are there's variance in the skills of the individuals that are trying to help, whether it be the lawyers or the brokers. It's messy, right? Yep. It's a messy marketplace. Giving a shout out to Brent Beshore in his book there that we're reading as part of this class, but it's a messy process, and but there's tools, tactics, techniques that'll help you, and we'll learn about that. That's essentially speaking to the seller and getting a hold of the seller of a company and communicating to them that you would like to buy their company.
Yep.
And building a relationship with them.
So this is all about the finding process. So we go direct or indirect. We're going to talk about tactics there. We're going to talk about tools, resources, databases. Mm-hmm. We're going to talk about all the different ways that you can kind of approach those. We're going to talk about things coming outbound, things hopefully coming inbound from what we're able to do at Sleeping Giant.
How you create inbound.
Yep.
All that stuff. Yep.
People reach out to you. Okay. So we're going to go about finding or sourcing all these. We're going to talk about it's a number game, big number game. Lots of companies don't want to buy, turns out. Is that right? Mm-hmm. Okay. So lots of companies I don't want to buy, but how do I know? I mean, it's a big number game. Some companies I want to buy, some companies I don't want to buy. What would be that? How do we make that determination?
Of whether we want to buy it or not?
Yeah.
Well, this gets to the next box, Doug.
Okay. Diligence.
And this is where as we go through this class, as an individual, you're going through Acquire, you are building your thesis, and your thesis on the type of company, how big of a company, what you want to do, the size, what you're willing to do. Do you want to do a turnaround versus an enduringly profitable company? We'll get into all these terms throughout the class, but this is essentially the strategy and analysis of every company that comes in is done in due diligence. There's preliminary due diligence. That's like you first see it, you do the market studies, the research, the strategy, and then you say, okay, I think I want to buy this. And then you do the secondary due diligence, which is more of the legal, making sure everything's correct, making sure the accounts are right. So this is where the strategy and finance comes in big in this class. And by strategy and finance, I'm like all business strategy. Does the company have good marketing? Does the company have a good team? Does the company have a good product? Does the company have a competitive position? Will that competitive position last? So you're building that thesis and that point of view. And we're going to talk a lot about point of view in this class. As an acquirer or aspiring owner operator, you have to build a point of view on that company that you can sell to the bankers, to the investors, to the seller, to the company's team once you take over. And that's all done in this due diligence phase.
So I find all these companies, it kind of also sounds like part of that target statement that we're going to be doing, that self-reflection is going to filter, so to speak. We're going to filter down some of those things before we actually go into our diligence. And some of these boxes are probably related to one another because I got to do a little bit of diligence to understand what I want to target in, right? Mm-hmm. So there's a little bit maybe of an arrow coming over here that, you're going to be figuring out what works best and what's attractive.
And if your sourcing is really good, right, your deal flow should pick up, which means essentially you're seeing a lot more companies, which means your due diligence and filtering better to get dialed in pretty quickly, or you're going to get swamped with too many companies coming in at once and not be able to do the proper analysis for each company.
So you're going to be taking that big stream, the deal flow, like water, filtering it down, getting down to those nuggets, and that filtering process is also a function of both what your skills are at, what knowledge, what industries you're good at, but then also some analysis of certain industries maybe that you want to target, or certain company sizes that you want to target, certain geographies that are going to kind of get that flow down into a smaller point. And then this diligence phase, this is analysis, this is strategy, this is finance, and it sounds like you're talking about it almost on two levels. One is the industry, and then another factor is the company. You want to just talk a little bit about what those two things are?
Yeah, so industry is like macro trends. Is this industry going to fold? You always want to be in a really strong industry that has a lot of tailwinds that have growth, so you're not fighting against that, right? Even the best managers in the world have trouble fighting against a dying industry. And company, you want to make sure the company's, and there's 2 points of view on this, has some strong foundation, has a good product or service, or if they're in distribution, has a good distribution network, has some core competencies that you can leverage. But you also might want to say opportunity or not opportunity. It's got some areas for growth that you can quickly identify and that you are able to apply, right? So you want to make sure the downside risk of it going out of business is much reduced, and the upside potential could maybe you've identified some growth opportunities.
So really, it's not only understanding the industry. I'm not buying into the typewriter industry. I'm buying into the smartphones. But then there's just variants within there. I'm going to buy a great smartphone company, not a bad one. Okay, once I get there, then I also have to say, what is my point of view on where I'm going to take that into the future?
And can I take it there? Do I
And
have
can
the
I take
skill
it
and
there?
ability to take it there? Is
Okay.
that something I want to spend my time doing?
So let's say I get to, I'm going to draw an arrow down here because I'm getting down to the end of my screen. I'm going to come over here. So we're kind of step one, step two, step three, sub steps in there. So we're coming here to step four. So let's say I do find, I've done my statement. I've got deals coming in. I know my industries that look good. I find a company. I'm like, man, this company looks good. I have a thesis on where I could take it. What happens next?
Well, now you put the deal together, right? So that is who's involved in the deal. You reach out to all the banks. You make sure the purchase agreement gets done. This is where all the lawyers and the experts, you start to really, and you can do this in the previous step, but make sure the experts agree with you and your point of view. You put a timeline in. Your lawyer is going to be big on the purchase agreement, the deal structure. You've got the money to solidified to acquire the company. And that could be from investors, from banks, from your personal wealth, from Uncle Johnny or Uncle Doug, and you've checked all the millions of boxes that have to be checked before you close. And we'll talk a lot about different deal structures. Is the seller involved? Is there earnouts? Is there seller notes? Is there, you've got your valuation. You've got someone to check your valuation for you. That's just, that's making sure that the deal is right for you and the seller, that you can negotiate that with the seller of the company.
So I get to the point where this company is attractive, and then I got to figure out how much is this company worth, right? What's the price? This company says it wants this. Is that really the price I want? Just like a house, right? So that's part of our valuation. We're gonna learn how to do that, and then once we know how much it costs, you're also going to be thinking at that same time, where is this money coming from? Is it me? Is it me in the bank? Is it me in the bank and Sleeping Giant? Is it just Uncle Johnny? Is it Uncle Mary or Aunt Mary? How is that money going to come to play to buy the company? And then I got all this this kind of structure and terms. So things like give maybe one example of what a variable term might be in a deal that would really change how a deal would go through.
The acquisition price. Is it up, down? Is it 3 or 4 times multiple? Is it on cash flow? Is it an asset versus a stock purchase? Are you talking items like, is the seller going to stay involved? Is the seller going to leave? Is the seller going to consult? Are you going to pay them to consult? The banks that come in, what terms and rates they're going to give you? Usually, want to go to 5-10 banks, right? Make sure you get a variety of options. And then in the legal documents, what are the reps, the warrants, the covenants? What's the purchase agreement look like? Those can all vary quite a bit.
And you have a great line that says a lot of people want to focus on price, but the terms are also important. What's the phrase?
Yeah, you name the price, I'll make the terms. So that's what Bishar always says. That I got stole that from him. It's great. It's in his podcast, and it's like price is one aspect of this. If you got a seller that wants to do an earnout based on revenue earned in the future, he's assuming some of that risk. So you can pay a higher price, maybe. but
Okay.
if you don't perform, he's not getting any of that money. So yeah.
So a zillion decisions, and it's kind of like almost three big buckets there under the deal of the structure, or the valuation, how much I want to pay for it, or how much it's actually worth it, and then how I finance it.
Yep.
And then let's
and then it's all in that part too. You got to make sure that you've checked all your stuff in secondary due diligence, right? The leases are in check, the contracts with the suppliers and buyers are in check. There's no outstanding things against the company. Lots of stuff there to close that deal. And this is where the reps and warrants and stuff come in the purchase agreement.
Okay. So, and a lot of parties that are coming to the table around that transaction, right? Accountants, lawyers, experts, a lot of documents.
LOIs, purchase agreements, non-disclosure agreements, what these all mean, how you use them. So yeah.
Okay.
Planning on how you're going to transfer. What's that transition going to be like? You start putting it together here.
So we go through this negotiation, bringing all these parties together, going through all the paperwork, all the choices, and we get it over the finish line. What happens next?
Well, then your new life begins. You are officially an owner operator of a company. You acquire the company, right? That's a short time period. And then you take that point of view that was done in your thesis, in your model, and you put it into play. You're now CEO. They're all looking at you, right? So all of a sudden you are running the company. What's the first 30 days going to be like? What's the first 10 days going to be like? What are you planning on doing the first 30 days, 10 days? And there's tips and tools in here, but you've got to take your point of view of what you want to do with the company, why you bought it, and you've got to start authentically managing that company as the owner operator. And that, everyone's going to be scared. Am I going to get fired? What's happening? What's going to change? People don't like change. And then on top of all that, making sure that, doing simple things, reaching out to all your customers, reaching out to your suppliers, introducing yourself, getting a hold of the sales funnel, getting a hold of the cashes, making sure the cash gets in your name, right? And the accounts get in your name. There's the tactical stuff, and then there's the leadership and culture stuff. Critical.
So you've then moved into this period of time where you're transitioning into leadership, meeting people, meeting a lot of people, probably
meeting a lot of people,
getting the feet under
strategy,
you,
doing your growth, getting your financials in order. There's a lot of stuff there.
And then you're kind of starting this in that transition phase. But during that transition phase, you're also probably starting to really implement your thesis, right? Your post acquisition growth strategies. Yep.
Right. And there's always going to be asymmetric information. So that is going to be the, here's what I wanted to do. I learned some things. I dropped some things from my thesis. I added some things to my thesis once I interviewed all of our customers and employees. Because remember, during due diligence, the seller is not going to let you interview every single customer and every single employee. Maybe some of them, but not everyone. So you want to make sure that you've touched base and you're constantly learning about the company, its little pieces and parts. You likely would have missed some things in diligence. So there's probably going to be some small things you got to take care of. And then you want to go into your growth plan. How are you going to grow the company? How are you going to make it successful? How are you going to make your employees' lives better, your customers' lives better, your suppliers' lives better, your life better, your family's life better?
And there you're probably thinking about taking that plan that you developed earlier on in this stuff, implementing it, and then obviously trying to develop relationships with other folks that can help you bring to bear and implement your growth strategy, whether that's around greater sales or marketing, or maybe looking at some of the costs. End of the day, we want these to be great companies that grow, but that sometimes can't be accomplished on your own. So you're going to be looking to you, to me, to other advisors to help you make that happen.
Yeah. Who's on your board? What's the make of the board going to be? How's it going to change? Who are you going to rely on for mentors? What partners? Both other firms, other people, your bank. You got to solidify all those relationships quickly.
So when you look kind of across these, four, I'm going to put the 5 here, the 6, we're just kind of, tentatively numbering them. These phases kind of blur together and they're iterative. And, but really, when you kind of step back from this model, to me, you start to see this has some you need to be good at psychology, self-understanding, have that. You need to be able to have great connections with relationships. You need to be able to lead. You need to be able to help people deal with change. So you have all of the people management part. You have a huge bucket on strategy, right? You got to be able to analyze industries, analyze companies, take a point of view, say where you think you can compete, where you can't compete, what's a good company, what's a bad company. All these are strategy questions. But then we're also looking at finance. We're looking at how we can actually, use money for us to acquire this company and where we might want to take it in the future. Got to know accounting, right? We got to be able to look back and see how we're going to account for some of those things we want to do, and paying back banks, and how is this firm actually performed to date. And so when you step back from all of this, you're really, you got legal concerns. This sounds like a model that for someone who needs to be open to learning, open to being more of a generalist. Is that how you'd characterize it?
That's how I'd characterize it. And then, once you're a CEO of a company, you got to think about, okay, what is my main focus going to be? But you're still going to have to change hats and be able to jump in all those other areas and take a part in those, and be able to support and assist them.
So I think this wraps up. So I'm excited about this.
Model.
This
I'm
is the
excited
general
for it.
model.
This
The
is each of the pieces of the class. So we're going to walk you through each of these in detail now. The rest of the class is spent on getting better at each of these pieces and how we make it successful. And it's not the only way. Some people find companies and they already have the company and they need to know, how do I acquire it, right? But
or they
going
have the
through these,
company. They have the company. Someone said, I want you to buy the company, but maybe they're not quite sure yet if it's a good idea to do that. Have they
to do
done the
that,
diligence to really see the bigger playing field of how this is going to work, and if
what
it's a good idea?
what's your opportunity cost? What are you comparing that company to?
Yeah.
Are there other companies for sale that might be better for you, a better fit, better industry? Yeah, so you got to really understand that. And then by going through this, you learn that maybe, hey, I really do have a good deal. I'm happy. I'm satisfied. I think I can do this, and I'm going to move.
And probably maybe one last parting word for this model is this is a high level view, and we're going to get into some of the details, but we can we can get you from the 30,000 foot down to the 10,000 foot. But there's between 10,000 feet in the ground, there's still so much that you're going to need to do and learn that we won't be able to cover. But those parts are critical.
This introduction to each of those parts, and we're gonna talk about pieces and parts, but we'll never be able to cover the whole thing in an 8-week module.
Boom.
Online. Boom. Bye bye for now, Doug.
Bye bye.
Acquire.